Jamie, I'm so excited to talk about quarterly earnings today. I mean, isn't it everybody's favorite topic?
I know I'm such a nerd, but yes, it absolutely is one of my favorite topics. It's one of the things that my husband immediately texted me when this first came across the Bloomberg.
That's awesome. That's awesome. So, well, and I caught my eye too, and I thought, well, we'll talk about what I thought. But if you think about it, every 90 days, corporate America essentially like holds its breath and waits for this big announcement, and then they let out like they just start this like nervous cough or laugh when they like miss by just the tiniest amount.
Yeah. Well, it's like final exams, but 4 times a year, right? So some people think we should cancel the test. And others want to know what happens when you stop checking the grades. I'm an investor, right? So you're probably going to know which side I'm going to fall into. But on today, on seriously, what could they be thinking? We're going to be exploring this hot topic.
That's awesome. So we got here. I've never lived in a world where we didn't have quarterly earnings. I didn't know what they were, obviously, when I was young. Now I know. But we're here because there was a suggestion by President Trump, actually in 2018, that
Yes.
we eliminate quarterly earnings. So what is that all about?
Okay, so let's talk a little bit about what we're talking about a little here. So we're talking about publicly traded companies here in the United States who are SEC filers. So back in 1938, when we had the SEC created, there was no real mandate on how often or what you needed to report on. By the time we get to the 1970s, in 1970, we moved to mandated quarterly reports, whereas most people had prior to that been semi-annual. Which is what's been going on. So we have mandated quarterly reports starting in 1970, and now we fast forward all the way to 2018, and Trump goes, I'm not sure we need to do this, and asked the SEC during his first administration to look into this. The
Right.
SEC does. It does. It creates an entire study. It opens it up for comment, and nothing happens, right? We stick with the quarterly reports. That's there. There are some legitimate arguments
There are.
about potentially changing it. That's there. And that's kind of what you and I are going to debate today. But I think the first thing we need to realize is that quarterly reports aren't always the norm.
Yeah, absolutely. And so, as I understand it, the reason to say they have to be quarterly is because, and especially the 70s, right? There was no internet, but we did have the personal computer, so we see businesses speeding up, and so in the public, all of us who are investing our pensions and in these firms, we don't have enough information to make insightful trades, right? So we need greater transparency about what's happening in these companies to protect our investments. At least that's the way I interpreted it.
You're absolutely right. And there's been a lot of studies out there showing the impact of earnings announcements. Okay.
Mhm.
So we're not talking about how frequently, but every time an earnings announcement happens, there is reports on how much the market moves. And the market tends to move on those days. I am a
Mhm.
small cap investor, I'm a micro cap investor. A lot of times, the only days that I can trade are on the days where they have reported earnings because there's enough volume generated on those days because there's interest in this tiny little company that I can move a significant amount of money either in or out of that particular stock. So, with that being said, it's not the same all over the world.
No, no. And in fact, the European Union moved, I think it was in 2013, to eliminate the quarterly reporting mandate. And their hypothesis was that, and we've talked about this previously, short-term quarterly expectations drive short-term decision making. And their research said that there wasn't really much benefit to investors. And so they made it optional for companies to report. Now, some companies are still reporting quarterly. I, when I initially heard that they're still reporting quarterly, I immediately thought, well, that's because their business is now built quarterly. But I don't know. What do you think they're doing it just because?
A couple of reasons why they're doing it. Number one, they're cross listed. Right. So if you're going to report, if you're going to be BP, for instance, British Petroleum, yeah, you're on the London Stock Exchange, but you're also on the New York Stock Exchange. If you're on the New York Stock Exchange, you have to file SEC reports, which means you're reporting quarterly anyway.
Got
Right.
it.
So a lot of the major big European companies still are on the quarterly cycle because they're forced to be. There's no reason to report over here and not report over there. Right. We've got worldwide information that's going on. So there isn't all of that. And there are some smaller exchanges over in Europe that did not switch to the annual report. So there are some that are there. But I find it really interesting. So let's pause and actually go through that first reason, because there's about 3 reasons why people say let's move to long-term items, right? The first one is that you're creating a short-term structure.
Right.
Okay. That by reporting every 90 days, you've created a new benchmark that everybody has to meet. And that's the one I want to dive into first. But let's go over the other options that are there. Number 2, it's really expensive. There's a compliance cost associated with this. And for smaller firms, that this might be a way for them to save money. That's there. And then number 3, you also incentivize based off of that short-termism. That is there. And so maybe by adjusting when you're reporting, you can also change how people are compensated, which once again will cause that first one. So let's dive to that first one first.
Right.
Does quarterly reports cause people to only look at what's happening in the quarter? What do you think? You've been on the inside before.
Yes. So quarterly reporting drives behavior 100%. Can I say that it always influences short-term behavior over long-term behavior? I can't say that. But we know that companies change their behavior to influence. It's earnings management, right? To influence that EPS number that shows up every single quarter. So some companies ask everybody to take their PTO right now because it's a liability, and we can accrue that expense. And others, they hold spending, they hold travel, right? So it's very, very common to do earnings management. And the question is, if we didn't have that short-term focus, would we make better longer-term decisions? But I also have a counter to that. So I would love to hear what you think about that first.
Well, I'll be honest. So I have only worked for one publicly traded company during my career, and I did not feel that same strain. But I didn't do a ton of travel in that particular role either, so it did not feel like any differences that is going on from an idea that you're playing more games that are there. What you're talking about with those items, which is actually take your PTO, stop traveling for that quarter. That's real earnings management. Okay, that means that you're actually taking physical action to legitimately maneuver earnings management, and that may cost you in hidden opportunity costs. By stopping travel, you may not get that contract signed, or you may not have that cost savings the next semester, next quarter, because you didn't implement that whatever.
You're not doing demand generation, right?
Absolutely. Something that we as investors will never see because it's opportunity cost. It's the loss cost associated with it, right? What we will see is the savings associated with the actual maneuver. Then there's also earnings gains, right? Which is the manipulation of how earnings are reported so that we can show ourselves better. Trying to pre-date a contract so that we can show that our back load is bigger, right? That I have a bigger amount of things to fulfill into the future so that I can manipulate that with what is going on. It is really kind of interesting the way all of this works. There is also a good point to point out, which is that what you have to report on a quarterly basis is slightly different than what you report on an annual basis. But overall, because we mainly focus on income and cash, it's not really that different.
Right. Well, okay. So some of the gaming that I heard you talk about, so you're backdating a contract. So most of that is illegal. Right? I mean, Sarbanes-Oxley is there for a reason, because companies were selling products to themselves and calling it revenue, right? I mean, that's so all that gaming is not kosher. So that's against the rules, and it will stay against the rules even without quarterly reporting. But there's a behavior, and it happens at least in almost every tech company, Jamie. So I don't know if it's in other ones, but there's the hockey stick effect. So every quarter has 13 weeks in it, and the last 2 weeks of the quarter, you get 50 to 60% of your revenue. In some companies, it's the last 2 days of the quarter, and it's because 20% of your sales reps are driving 80% of your revenue. They have a plan, and then they pull forward any revenue from the next quarter into this quarter to make their target. And so my question is, if you take your foot off the pedal, if we say no more quarterly earnings, are revenues going to decline? Because you're not going to have that repeated behavior, right? Or I don't know, maybe incentives will stay the same in quarterly, but there's this hierarchical pressure. I mean, like salespeople can almost literally feel it on their shoulders of all the 12 people above them calling them and say, is that deal going to come in, right? Is that going to go away?
And you may just maneuver it out, right? Which is, instead of it having happen on every 90 days, if we're going to move to semi-annual, every 180 days, all of a sudden you have a
the
big
system's designed for that, right? So I'm just like, and so here's me. I've been in sales for too long, but can you push through? If you're a $1 billion company, are you capable of pushing $500 million through in 2 days? I don't know.
Well, that's the issue. I have a really hard time with the idea that moving from quarterly to semi-annually, that you will somehow fix this short-termism attitude towards individuals, because the reality is 6 months comes up and you still have to report. The argument is that it's they're going to look short term. They're not going to invest in long-term investments because of this idea. I'm sorry, but 6 months is not that much better than 3 months, right? If I am trying to build the next cancer drug, if I am trying to build the next driverless car, I'm going to need more than 6 months anyway. Right. So I'm not going to eliminate that short-term beats long-term issue, in my opinion, that's there. What I am going to sacrifice is a lot of information coming out to the public.
Yes. And I had thought that, so this was all set up in the 70s, at least in the US, it was all established in the 70s, that quarterly reporting. No, we had no internet at the time, or no commercial internet. And so I thought, well, maybe with the rise of the internet, the need for quarterly reporting would decrease because it just feels like information flows more readily. But when the EU took away the quarterly reporting, and the companies that chose to stop reporting, the investors said they actually got less information. So there's an actual, from what we're seeing in the EU, there's an actual information trade-off. I don't know, is that, I'm sure itchy as an investor, right?
I completely understand it. And it also depends on what part of the market you are in. Right. I'm going to say that too, because let's start with mega caps that are going to happen, right? So we're talking about Apple, NVIDIA, all of these items, right? They're reporting on a quarterly basis. In addition, they are going to various industry events where they are presenting associated with that. They are also issuing press releases, okay? Right. So the information that comes out of Apple is almost daily, despite the fact they report quarterly. Now, we care a lot more about those quarterly reports than the individual items, but those are all hints about what is going on. They have entire teams of investor relations that are dealing with that on an everyday basis. That's true for mega caps. That's true for most large cap companies. Right. When you start getting into the small and especially micro cap companies, you have a very different story about what you hear and what you can get information on from these companies. A lot of times, the only time you hear from the companies is when they're issuing their quarterly earnings reports. Right. You don't get press releases in between time because they don't want to spend the money on it. You don't get them at various conferences because most of the time these are owner operators whose entire business really is about running the business. It's not about courting investors. That's dealing with it. So we have a significant cost of being public by reporting it. But as an investor, it's the only time I get information.
Right. Yeah.
And so if you take that away,
it makes it more challenging. Right. For you to.
And we're talking about companies that are statistically more likely to go bankrupt.
Right.
Statistically more likely to have revenue and cash flow problems. And now you as an investor are going to find out about these on a much slower basis.
Yes. Okay. So we actually have a comment. I'm so excited. Tim's out here. Hi, Tim. Tim McConaughey. He says he dislikes quarterly earnings because they incentivize a lack of strategic direction and they incentivize balancing the books. I know I've seen it. I know I've seen the behavior, and you lose your talent in favor of in favor of growth. I I have seen that too, Tim. The thing I think about is there a way for us to have our cake and eat it too? And so when we talk about earnings, a lot of the fluctuation in the price after you report the earnings comes from earnings forecast.
Yes.
So the question I have, like, is there a balance? And I don't know what this means for small companies, because I know small companies are bearing the weight of this, but you need the transparency so you can intervene if they're tending towards bankruptcy or something. But could it be that we eliminate the requirement that you forecast some sort of earnings? Do we require that you
There
forecast
is no
earnings?
requirement.
There's no requirement.
That's really interesting argument that you're sitting there, Cindy, because while they are required to report historical last 3-month quarterly, any sort of guidance, forward-looking guidance, is 100% voluntary by the company. It is basically what investors have forced the company to do, because nobody likes giving those. I got to tell you, nobody's like, please let me share my internal opinions of what's going to happen. Yet they are kind of forced to do it by the demand from the institutional investors.
Right.
So, what's happening.
And the company that Tim and I are both most familiar with was doing it quarterly, switched to annually, which is a much better way to do it. If you're going to give an opinion, give it annually. And still, I think it decreased that immediate pressure that we were seeing, because if you make a commitment to next quarter, if you don't stick to it, you're in trouble. But if you make an annual commitment, it gives you a little more flexibility, but still
a little bit, because let's be honest, a year is made up of just 4 quarters, right? So you've given at the beginning of the year, you're saying, okay, here, and you get some flexibility in Q1. But by the time you hit Q3, there's only 1 quarter left. Like everything that you've done up until that point, you're basically giving a quarterly item, right? At 2Q, you've got a 6-month guidance. At 1Q, it's 9-month guidance. Like you're just constantly shortening that guidance because everybody's just already kind of looking towards the next year as well. It is so hard. It is really impossible. I understand from an internal point of view why this is bad.
Yes.
I also understand from an external point of view why I desperately want it and why I don't want it to disappear. And the question becomes, who's actually going to go ahead and adopt this? We can move this to voluntary. That's there. And I think you will find kind of a stratification of what happens. I think it's going to end up becoming industry specific. That's there. Because I'll be honest, as an investor, if the utility companies want to report every 6 months, I could care less. I just don't care with what's happening and what's going on. If Apple or Nvidia wanted to report only every 6 months, oh my gosh, think about 6 months in the time of world of AI. Think of how much is going to change. If I got crickets from Nvidia, the ability to either have rumors create bubbles or lack of information cause significant declines in the market, right? There's a lot of question marks associated with it. And now that we have worldwide around the clock 24-hour trading, right? The volume of data coming out has really kept up with how we trade in the real world. If we make a disconnect there, we may see companies falter because there are going to be costs, right? Because reporting it increases volatility, but it decreases the cost of capital.
Well, I think, which is a real thing, right? So it decreases the cost of capital. So just make everybody understands it costs less to borrow money, right? More transparency means you get to borrow money at a lower rate. But I also, you mentioned that companies may do it voluntarily based on industry. I think companies are going to do it voluntarily because, like, think about your NVIDIA example. The press releases are every single day, just like Apple, because not only are they trying to essentially advertise themselves, but they're also trying to influence the political environment around them. So you see a press release from Jensen Huang saying, China is locking us out. That is not, that's a signal. There's a political signal as well. He's trying to engage his resources to help in dealing with another market. So I think we'll see an awful lot of voluntary reporting regardless. As a leader, so if we look at the leaders in the organization, the managers who are making decisions, it scares the heck out of me, Jamie. It does. Like, if I understand that people need periods of rest and people needs period, they need seasons. Seasons need to be maybe a little longer so that we can rest more in between. But without that artificial quarterly cadence, I am really worried about the first 3 months out of the 6, or the first 4 months out of the 6. Are we going to have motivators? Do we know how to motivate people when there's no quarter end? I don't know. I think I do.
I really do. And I think if we do move to the end of this and we do semi-annual, it will be very interesting to see who is a leader in this and who is a follower, right? Like the company that first dares to say, okay, we're going to go to semi-annual. What type of company is that? What is going to happen? For me as an investor, I'm going to go back to it. The bigger the company, the more likely they are to just go ahead and voluntarily stay on this path. And so I'm fine with it. The smaller the company, there is some real costs associated with this compliance associated with quarterly earnings. The number of microcap stocks available on the market has been shrinking dramatically over the past 20 years because the cost of being public has been so much more significant. And there are other avenues. There's angel investors, venture capital, and other items that basically are saying you have to be so big in order to really understand the cost of being public. So these micro cap companies that, there's this little hub in Minnesota. Don't ask me why, but Minnesota has a huge amount of micro cap companies that are publicly traded. And it is really interesting because a lot of times when I go as an investor and look at it, I go, why the hell are you public? It doesn't make a lot of sense. You don't tap the capital markets. You're not really getting any benefit associated with it. Why are you not delisted? Go on the OTC and shed yourself from what can be a $700, $1 million annual regulatory cost for a company who only makes like $3 million a year. Think about shedding that cost, hiring the external IRs rather than having an internal person because you're not big enough to deal with it. Now, those individuals really have a legitimate argument about the cost of being public. And there are some concessions already in the system for them. For instance, 10Ks have to come out in 60 days if you're over a certain size. Otherwise, you get 90 days.
Oh, got it. Okay.
Quarterly reports, you get 30 days to issue them, or 45 if you're a certain size, right? So we have a bifurcated requirement as far as how long you get to actually do the accounting behind the reports, because we recognize there's a greater burden on smaller companies. We could suggest to do the same thing with the 6 months. If you're under this size, only have to report by 6 months. You on this size can only report every quarter. We could do something like that, but there's a true cost associated with it. The only days that I trade, I've told you this already, the only days I trade oftentimes are the days that they release earnings. If they don't release earnings, because they also don't issue press releases, they're not at all the different conferences and stuff like that. There is not enough trading volume for me to get in and out of these places.
Got it.
And so what I actually think will result is that if you do this, people like me are going to be even less interested in microcap stocks. We will see the cost of capital go way up, and we will see a lot of these guys potentially even delist. Isn't that a weird, a suggestion? Like, oh, if I'm going to make this easier on you, you're going to be more likely to delist.
Yeah. Okay. So I know we had sort of an outline we were going to follow, and we're all over the place, which is awesome. But okay, so is having more publicly traded stocks good for society?
Oh,
I don't know the answer to that.
So, the argument being that it gives you equal access to be able to invest across the nation, right? So
it's like
I as a microcap
investment.
Yeah. Whereas if you keep it in the hands of private equity permanently, right? If you literally take away the incentive to be public because it raises your cost of capital so much. And I'm not sure if my hypothesis is correct, to be honest. It could be completely wrong. I may be much more happy that stock, and that's very possible, becomes 33% more profitable because they don't have that, as much compliance costs associated with it. But I also think that this is a trend that's happening anyway. And publicly traded companies are there because no one person can own them privately. right? It's just really got too big. We have corporations now that are unheard of in size.
Right.
They were not imaginable even 50 years ago, to have a company the size of Walmart. I mean,
Right.
think about it. This does not exist. The number of employees and everything else. So you have to be public there, and it has done great things for us. If you lose the smaller cap ones, what you do is you give the private equity companies more and more fodder to be able to buy these small guys out, combine them into a big company, and then issue them as being public. And I would say that is a bad thing, that's going to happen, because if you're always a part of a mega corporation, you have very few smaller corporations that are there, right? That you end up causing some real innovation problems and
Innovation
other items
driven.
like that.
Yeah.
The smaller companies are more nimble. They're the ones creating the new technology, and items like that. And I would say you're going to then hand political and economic power into a smaller and smaller set of hands, which I
Right.
also think would be
It's bad for
a
society.
bad
Yeah.
idea for society.
Well, I know, and I know we got to wrap it up here, but I want to throw it out there that I sort of see Kickstarter as we, my husband and I, well, mostly him. He's smarter of the two of us, but he goes out and finds really cool inventions on Kickstarter, which I think is a very similar concept to a small publicly traded company. We get to invest in the company. We get something back. We don't get return. We don't get cash, but we get products in our investment. But maybe there's a way for us to continue this democratization of investment into things that we find interesting. We are investing in a very low priced trading card sorter that we talked about building ourselves. We're like, we really don't want to do this, so somebody else is doing it, because there's a market for that. But I don't know. Is the Kickstarters and crowdfunding the answer for small caps, or is it really just private equity?
I think that there's always going to be innovations, right? That's happening. Private equity really wasn't a thing, 40 years ago. It was leveraged buyouts then. It's really private equity, same thing, right? Except it was a lot I got distracted.
Sorry, I didn't mean to distract you.
What ruined the stock market was allowing companies to be sued by shareholders for not doing everything possible to maximize profits, including destroying stakeholders and the company itself, forcing companies to be beholden to stockholders. I think it's a really fascinating point. I always find it interesting when stockholders sue the company that they own, because it's never the stockholders who are still invested in the company. It's always the stockholders who sold out already,
right?
Because otherwise you're just suing yourself, and that doesn't make a lot of sense.
Right. But it's a really great point that how should we in some ways protect corporations from litigation? Although I'm one of the people who advocates for more activist investing, but I think you have to be a shareholder to be an activist, right? So, but I think that's a really interesting point, Tim.
Yeah. No, that is interesting. But I'm going to kind of wrap up my own opinions associated with this. It is not clear to me, despite me really wanting all of those quarterly earnings, that actually changing to semi-annual is going to be the disaster that so many investors think it could be. Like, we can go to extremes. I think in reality, what's going to happen is, whether or not we stick with quarterly or we go to semi-annual, a bulk of the ones that everybody knows of will remain on a quarterly basis. Because that is the norm of the industry. Will there be certain industries that change that norm? I think so. But I think you'll find those in the kind of more staid old industries, and that the technology people are going to remain on that quarterly thing because they want those earnings. They want those sales every 90 days. They don't want to suggest that 180 days is the way to go. What will become interesting is if we start seeing more companies who first IPO, right? Start with that 6-month adoption and not adopt quarterly earnings. And as they grow in size and they become the next NVIDIAs, the next Microsofts, 20, 30 years from now, we may slowly see a change in this culture that we don't see today.
Right. Absolutely. Well, the other thing, I had an immediate allergic reaction to it just because I was in a sales organization. I'm like, how are you going to get rid of the quarterly pressure? But I think you're right. I think companies are so well formed around this habit, the big ones anyway, right? They'll continue to keep the quarterly reporting. They'll do it anyway. They're already responding to the investors' requests, like you mentioned, by doing earnings, projecting earnings, that kind of thing, even though they obviously don't want to. But I also think that, to your earlier point as well, it's not going to change short-term behavior. Short-term behavior is short-term behavior. We've got to change the way we incentivize CEOs. It has to be like, I'm still thinking about, how do we pay a CEO for the performance of the company after they're gone? And I know you really don't like that, but I'm still like, there's got to be a way. So
Yeah,
we've got to change
trying
that.
to incentivize that long-term strategy, right? Because
Yeah.
if you're managing a business on one earnings call at a time, it's probably time to check your calendar and ask, is your calendar driving your strategy, or is your strategy driving your business? Like, that's the question, right? So
Absolutely.
it's rough.
This has been fun, Jamie. Thank you, as always, for the spirited conversation. And for everybody out there, until next time, keep your spreadsheets handy and your coffee strong.